Hey everyone, how's it going? We had a nice, fun, profitable, hopefully profitable trading session to close out the week. It was very directional, but there wasn't a lot of volume to it. We'll take a look at that in just a moment. But the overall theme of the day was basically risk off. When we started the session this morning, the first thing we saw was that divergence between the Nasdaq and the Dow Jones. And even though everything was up or relatively flat, it seemed like the risk appetite just wasn't there anymore, and that we really saw that risk appetite taper off throughout the day. So let's just take a look at how that looked. So in the S&P, when we opened up, we were higher. We did open higher and move higher initially, but as we got close to 7 o'clock, so just before 7 o'clock, before our consumer sentiment report, we just started to move downwards, and we basically went down ever since. We ended the day a little bit sideways, but there was definitely a directional theme of going down, taking risk off the table. This isn't so much as bearish selling, because if we look on the day, it's not that big of a bar, right? It's about the same as yesterday. It was about the same actually, not the last week or so. So it's not like we had a huge bar. It's just that it was directional on the day, but even though it's directional on the day, it's when we look at daily chart, it's not that directional. It's mostly sideways. We're still in between that EMA 20 and the MA 50, the EMA 8. Looks like maybe the EMA 8 rather than the EMA 20. Those two are very close levels. So what we see here is also the volume bar is not that high. It is a little bit below average. So overall, we would call this just a muted session with a downward bias to it. In any case, it really was risk off. Take risk off over the weekend. So we saw money move into hedging type of assets like TLT, like bonds. So bonds over here up, well, it doesn't, kind of hard to tell, but this was the close yesterday, and this is where we closed today. So we're up 1.8%, so definitely movement into bonds. And then also we saw saw money move into things like gold with a huge jump up and continued motion higher. So we really see portfolio managers hedging their positions without having to sell everything off. And in fact, that's what, if you're in any of my classes or any of my services, then you would have seen me say, hey, we're going to take our risk off over the weekend also. So either we went completely flat or we delta hedged. And if you don't know how to delta hedge, that's something that I can go over at some other time, not today, but it's definitely something that I recommend that you learn how to do so that you can hang on to positions that you like, but be hedged over the weekend. Because you'd rather, well, from a risk and money management perspective, we would rather miss out on a move than risk a big loss. So next weekend, or no, or sorry, next week on Monday when we open, what if we gap up? If I'm well hedged or perfectly hedged, I'm not going to make it anything on that gap up. And maybe if I didn't hedge, I would make a bunch of money. But equally, if there's a big move downwards, I would lose a bunch of money. And so I'd rather be in a neutral position where I'm not going to make a whole bunch or lose a whole bunch on any large moves, but I'm very safe. And especially right now in the markets, we have greater risk of downside movement than we do of suddenly gapping upwards. So we had a whole week of negative news. The market went up in spite of it, but then we kind of reached this point where we're close to that MA 50 and didn't quite get there, and we started to move downwards, and we're still in this range. We're still not in danger yet, but if we break down on Monday, then we could go down and retest these lows. So it's a lot better for us to be hedged against that and miss out on some upside move, which would likely just be into the MA 50 anyways, and just say, hey, okay, maybe we hit the MA 50 on Monday, and then if we cross over, then we can re-enter and go long on the market. So it's better for us to kind of play this wait and see game, let the market show its hand before we actually go in. Let's take a look at all the indices, not just the SPY. So let's take a look at QQQ. QQQ sold off today. It sold down below the MA 50 through EMA 8 and held at the EMA 20. So this is what I was talking about. We'd rather, now that we're seeing more risk in the markets, we had that risk appetite go away. There's less risk appetite, which means we're less willing to take on risk, which means that we have a greater risk to the downside. So this was an important point. The MA50, like I said earlier this morning, it's a very important point that a lot of institutional traders are required to use it as a guideline in their positions. So for example, if we break down below any stock, not just the index, any stock that breaks below its MA50, a portfolio manager may be required by the rules of his firm or the rules of his portfolio to get rid of those stocks if they stay below for a certain amount of time. So you see portfolio managers defend lines like the MA50 or be forced to reallocate based on lines like the MA50. MA50 is a super popular one. So as a portfolio manager, if I lose money on the quarter and they go, well, why'd you lose money? Why were you in the stock? You lost money. I could just say, oh, well, it's above the MA50. And that's defensible. Say, well, it's still above its MA50. It's still good. There's not much that a risk manager could come after me for if it's still above the MA50. But if I lose money and I hang on to it below the MA50 and they go, look, why did you hang on to us? It's below the MA50. I might lose my job, right? So this MA50 is a very important psychological line for institutional traders. So now that we're below that in the QQQ, we're below it in the SPY, we are below it in the Dow Jones, we're definitely below it in the Russell 2000. So if we don't quickly cross back above, so we'd say Monday or Tuesday, we don't cross back above the MA50, then the likelihood of seeing continued downside motion starts to become a lot greater. And if that happens, what we see is lower high, lower high, lower high, lower high. So technically, we never broke through the downtrend. Okay, so that would suggest if we break below, then we'll have the resumption of the downtrend, and we're really going to want to be heavy on the short side rather than the long side. We were getting enthusiastic, things were looking very good, but it just hasn't quite turned out that way so far. So the same thing over here. Lower highs, this one's much lower high. So right now, even though in the very, very short term, I'm saying 1 to 2 trading sessions, I'm looking at this range for it to be trading in. But if it breaks below this EMA 8 and EMA 20 region, and this red line that I just drew right here, then we're going to be on correction mode once more. So that's why if you were in any of my classes or services, we went flat or delta neutral. All right, let's take a look what happened in our sectors since last week. You can see that energies carried through. SMH went way down today, so it went flat since the compared to last week. So what we're seeing is that reduced risk appetite. If we go into next week and it starts to move up again, then you'll probably see a lot of money re-enter SMH. But if you don't see it coming in, then we can probably be pretty sure that SMH is going to continue to move down, and we're going to go into more defensive sectors. And that's what we're seeing right here. E is not really necessarily a defensive sector, but that's a reflection of economic concerns, fuel supply concerns. But right here, XLU is definitely a more defensive sector. And then we saw XLP go from the bottom to move up about a third of the way up. So I'd really be watching U and P. And in industrials, if we expect this to go into a longer time frame war period, extended war. Now we've got two of them going on around the world. Then we'll start to see industrials start to perform very well as well. So it is near the top of the list right now, but you can see that there's a spread. There's quite a spread. 4%, 3%, 3%, 2%. XLI is only here at 0.83%. So it's still early on XLI. But for now, I'd be watching XLU very carefully, and I'd be waiting to see which direction SMH decides to go. Yeah, so that's a large. This is reflective of the of QQQ, but slightly stronger because it just barely went through the MA50 and EMA8. It's still some distance to the EMA20. So we really want to see Monday, Tuesday, what happens is that in SMH and QQQ, and that will form our opinion of what's going to happen for the rest of the week and maybe even in a slightly longer time frame. All right, so let's take a quick look at how our day trades went. So at 7 o'clock, I added a line right here at Tesla, and I added this line up here on Dollar General. So let's see how we might have played. Oops. So Netflix didn't really do anything. It just kind of popped inside that region that we looked at. So there was no trade in Netflix. Here you can see that if we had, before we had this purple line, before 7, right, that's what we're waiting for that consumer sentiment report to come out. When we traded back up to this area right here, that could have been a signal for us to, actually that's pullback, not breakout. So we wouldn't have traded that. We already had this line. And then over here, if it broke out, or if you're really saying, Kane, I wanted to do the pullbacks because that's more guaranteed than right here. When it pulled back over here, then this would have been an entry point right here. So we'll just quickly mark that right there. And then on our Heikin Ashis, either an area of consolidation, so you could have exited right here, or if you waited for the Heikin Ashis, then you would have been right here. Okay, so that's from about 110.60 to 111.70. Not bad. So 1 point something percent, so probably about a 10 to 20% gain on options right here. And then over here on Tesla, when it broke down over here, we waited for that report at 7. Then you could see that it went up and then failed, and it consolidated and started to fall through again. So we could have gone in over here on this breakdown, and then the Heikin Ashis. 1, 2, 1, 2, 1, 2, 3, 4, 5, right there. Okay. So a much juicier trade in Tesla today. Okay, so from 256.75 down to 253.95. I did something wrong there. From 256.75 to 253.9. In any case, about 2%. So again, at least about a 15 or 20% gain on the option, maybe more. This was pretty big motion right here. But so percentage-wise, on the stock, it was about the same. But the speed of motion would have caused a greater leverage in the options, and that would have been a bigger gain. And then from JD right here, there was a trade, right? So right here, we bounced and went back up. So that was a trade right there. So We'll just do a quick estimate, probably something like this. Okay, so about 20, once again, another 15 or 20%. So a lot of these day trades are good for 10, 15, 20%. I know a lot of people sometimes when they day trade, I'm talking about a little bit longer dated option. If you did the 0 day to expiration option, which was available for anything that has weekly options today, so definitely Netflix, Dollar General, Tesla, all 4 of these have weekly options. So you could have traded a 0 day to expiration option, and that would have been much higher leverage, much higher percentage gain. So hopefully you guys are getting a hang of how to look at these day trades. And there are other people who do other methods where maybe it's more lucrative. You see like 15, 20, 40, 50, 100, 200% gains, but they're staring at their computer screens nonstop and worrying about everything. So this methodology is more hands-off. It's a little bit more relaxed. But of course, if you wanted to sit and stare at your screens, you could switch to a different strategy. All right, so let's take a look at how we have some trades that we've been looking at that expire today. So actually I closed one already, so I need to look at these expired or closed ones. The one I closed was Charter, Aftermarket Charter, November 17th. The reason why I closed it was I did not notice earlier this week, we already crossed above our target gain. So we should have closed it on Wednesday, but I didn't notice it until right at the beginning of the market this morning. And so I just go ahead and closed it right at the beginning of the market. So if we had been on time, we probably would have made a tiny bit more. There wasn't a lot of change in prices since then, but there was time value, right? So it would have made a tiny bit more, but as it was, Charter made 26% right there. And we were only, that was about a 1 week trade right there. And then if we look at the ones that expire today, we've got this. Oh, they already closed them for me. Okay, so we had a Microsoft trade. I guess, did they delete it? Oh, must be on the next page. Not Microsoft, Meta. We had a Meta trade, 8.7%. That was let me see if I can open this again. Nope, they don't let me because it is expired. Remember, that was a super high probability, high risk to reward trade where we are only planning on making about 8 or 9% over 1 week or two. I don't remember if it was 1 week or 2 weeks, but it was a very high probability trade but not a huge reward trade. So when we look at Meta, right, we made the full expected 8.7%. Let's see what else. Unfortunately don't remember all of them. So I've got to XLU, nope. Aftermarket Google, DLR, Costco. Costco is, yes, October 13th expiration. Costco made the full, no, we closed that earlier. No, we let that expire. So it made 27%. That was probably exactly what we were expecting. It was another vertical where you had a limited maximum gain and a maximum loss. In this case, there was a much better ratio than what we put it on for Meta. There's at least one more. Charter we already talked about. I closed it out. And Butterfly, that might have been it. I guess that might have been it. Okay. So, and then let's see if we have anything still active. 1% extrinsic. This was what we talked about yesterday. And Look at this huge move in SMH today. Huge move, right? But we did it 1% extrinsic value. So even though there was that huge move, we're only sitting at a 10% loss right now. So that's the advantage of using 1% extrinsic value. You're very insulated, right? Because in the underlying, it already moved 2.5%, and we only moved 10%. And normally we would expect to move 10 to 20 times the underlying move. So this, if you had gone at the money, so a 2.5% would be like a 25 to 50% loss in just a single day, whereas we were much more insulated by it. And like I said, in this one, we manage our risk. We don't allow it to lose more than 20 to 30%, but we're sitting very well at minus 10% over here. Okay, and then, was there another one? I think there was another one. We have this aftermarket VRSK. This is looking very good. This one is out to next week. Another high probability trade, and this one's doing very well. It looks like VRSK could go a little longer, and you see that even with the down day, VRSK was very strong. How did we pick this? If you remember, VRSK is part of one of the strongest sectors that we had going into this, which was communications. It was one of the top ones. And so we go into the strongest stocks and the strongest sectors. And so they tend to remain strong even on down market days. Normally we expect them to just fall less than the overall market, but VRSK is so strong that it actually still continue to make gains. We are getting very close to top right here, to previous highs. So I would probably just close this one out and go ahead and take the profit on it. So we can do that. VRSK, we'll just go ahead and take this profit. Okay. And then we also have this pre-market trade that we did on the employment situation. We did that 1 or 2 Fridays ago. And you can see that on paper, it looks like it's losing money, and it's losing quite a bit, 65%. But these types of trades, we have to remember that we're really just playing with time value, and time value pushes us into this final curve towards the end. And if all we have to do is just sit here and wait, because time will do the work for us. And by next Friday, assuming we don't breach 43.58, then we'll be sitting here making our expected profit of 720. And if we land somewhere over here, then we'll make more than that. Okay. So this one's still looking very good too. It's just this type of trade, you have to get used to looking like you're losing money the entire trade until the very last minute. So it takes a different type of emotional fortitude to go into this type of trade. All right. Let's see. Overall, we're just taking risk off. We want to see what the weekend has for us, and then reevaluate on Monday how the market is reacting to anything that happened over the weekend. And then Tuesday is really when I'll be looking to potentially put on new trades. So we're treating this as if I'm managing a professional portfolio, right? So I'm not going to look at any new trades today, swing trades today, because that's not what I mean. That's the opposite of what I was doing. I was hedging all my positions and getting rid of positions that either already made money and I was comfortable letting go, or that it didn't seem like they're the best positions to be in at this particular point in time, and I either take the small loss or small gain that was already inside of it. So let's just wait and see. Hopefully everyone has a wonderful and peaceful weekend and things get a little bit better around the world. But either way, or whatever happens, we'll be ready on Monday to evaluate everything and see where we can start moving money. All right. Any questions? Anything you want me to go over? No? Okay. All right. So Have a wonderful weekend, everyone, and I will see you guys on Monday.